We're jumping straight into SELLAS Life Sciences today. I mean, everyone is watching the price action.
Oh, absolutely.
It recently just shattered that key $5 level.
Yeah.
First time in, what, over 3 years?
That's right. But the real story, the thing you really need to be focused on, is the imminent outcome of their phase 3 clinical trial. Regal.
Imminent is the word. We're literally just 8 survival events away from the final data. The unblinding.
Exactly. And this isn't just another stock story. This is a pure, a high-stakes binary bet.
Total binary event.
And we need to unpack why the trial's timeline, the fact that it's taking a bit longer, might actually be a really good sign for investors.
Okay, that's the hook.
You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
If you're enjoying the analysis, make sure to subscribe and hit that like button. It really does help the channel. And definitely let us know in the comments which company you want us to simplify next.
All right, let's get into it. The immense risk and, well, the equally immense reward facing SELLAS Life Sciences. Let's start with what they actually make.
Okay, let's unpack this. So, as you said, we're looking at an oncology biotech with, what, 0 product revenue today?
0. The value isn't in sales.
The entire valuation is anchored in its pipeline.
Yeah.
Specifically, 2 key assets, right? Galinpepimut-S, or GPS, and SLS009.
And that pipeline is built on a very specific competitive moat. Their core IP targets the Wilms tumor 1 antigen, WT1.
And why is that specific antigen so important?
Well, it's not just any cancer marker. WT1 is a protein that's overexpressed in a whole host of cancers, but, and this is the key part, it's often found on cancer stem cells in diseases like acute myeloid leukemia, AML.
So if you can target the stem cell, you're getting at the root of the cancer, not just, the bulk of the tumor.
Precisely. That's the whole strategy. Which brings us to asset 1, GPS.
Yeah.
This is the one everyone is laser focused on right now.
Right.
GPS is an immunotherapy, a peptide vaccine that targets that WT1 antigen specifically in AML.
And it's for patients in the maintenance phase, after a second complete remission.
Correct. Post-CR2.
Wait a second. If it's for the maintenance phase, that means patients are already in remission. So is the market opportunity really that massive? It sounds like a pretty small, highly defined niche.
And that is an excellent point. It's something that gets missed a lot. Yes, the niche is specific, but the need is massive.
How so?
Even after getting to a second remission, the relapse rate for these patients is incredibly high. The prognosis is it's generally poor. We're talking survival measured in months, not years.
So there's nothing else for them right now.
Very little. It's essentially a huge unmet medical need. If GPS can just delay or prevent that relapse, even in this small group, it fills a massive therapeutic void.
Okay, that clarifies the GPS market. So let's talk about asset 2, SLS009. This is the diversification piece of the puzzle, isn't it?
It is. It's not an immunotherapy like GPS. SLS009, or tambiciclib, is a small molecule inhibitor. It targets something called CDK9.
And CDK9 does what exactly?
Think of it as essential for transcription in a lot of cancer cells. So by inhibiting it, you basically block the cancer cell's ability to make the proteins it needs to survive. And that leads to programmed cell death, apoptosis.
And the data there for relapsed and refractory AML, that's a notoriously difficult group to treat.
Yeah.
What did the phase 2 trial show?
The phase 2 results were frankly highly compelling. In that really difficult patient population, they got a 46% overall response rate across all cohorts.
46%.
But here's the crucial part. For patients who had only had one prior line of therapy, so a bit less heavily treated, that response rate jumped to 58%.
Wow. And what's the standard of care usually get?
You're lucky to hit response rates in the 20 to 30% range. So seeing numbers near 50% or even higher suggests some really powerful biological activity.
That does a lot to de-risk the company from being, a one-trick pony.
It does.
So the strategy here is that SELLAS is building a focused AML franchise. You have GPS for long-term maintenance and SLS009 for the immediate high-risk relapse patients.
Exactly. And that kind of complementary focus, backed by late-stage data, makes them an incredibly attractive M&A target for a bigger oncology player.
Okay, but let's slam the brakes for a second. Let's talk about the financial paradox here, because this is where a skeptic would really dig in.
Good. Yeah, let's do that.
We're talking about a company with 0 revenue and a pre-tax margin that's, I saw a number like negative 460%. That just screams financial risk and cash burn.
It does, and that is the fundamental bear case. They are a loss-making development stage biotech. That's a fact. But the financial health right now is surprisingly robust.
Robust? How? I mean, with the cost of a phase 3 trial, how long can they really last?
Well, let's look at the liquidity. At the end of Q3 last year, they had about $44 million in cash. Then they got another $29 million from warrant exercises in October.
So that brings their pro forma liquidity up to around $73 million.
Roughly, yeah. A very substantial capital buffer.
But that came at a cost, right?
Yeah.
Those warrant exercises were dilutive. They issued more shares.
They did, and dilution is always a short-term negative for existing shareholders, no question. However, it was a really necessary strategic move.
How so?
It extended their cash runway through their two most critical milestones: the Regal unblinding and starting the next SLS-009 trials. By getting that cash now, they've removed the immediate need to go back to the markets, which, always creates an overhang on the stock.
So they traded a little near-term dilution for certainty of funding through the catalyst. That makes sense. And their solvency metrics back this up.
Absolutely. Their current ratio is around 8.3. That means they have $8.30 in liquid assets for every dollar of current liability. It shows they're really not in any near-term trouble.
Okay, so let's pivot now to the main event, the timing of this Regal trial, which is what's driving all the Trice action.
Right. So as of late December, the trial had seen 72 of the 80 required overall survival events.
And that 80th event is the trigger for the final analysis, the unblinding.
Exactly. And the consensus is that this is going to happen imminently, probably in the first quarter of this year.
Now here's where it gets really interesting and a little technical, but it's critical. Management noted that the event rate, the speed at which those deaths happened, was slower than they originally anticipated. Why is that delay a good thing?
This is a classic kind of counterintuitive signal in oncology trials. When you run a trial like this, your statistics assume a certain number of events, deaths will happen over a certain time if the drug does nothing.
The null hypothesis.
Right, so when the actual event rate slows down, it means patients are living longer than expected. And that suggests one of two things. Either the control arm is doing better than expected, or
the treatment arm, the GPS arm, is performing significantly better than the control arm.
Precisely. The market is basically betting on the biology here, that GPS is the reason for the delay. The longer it takes to hit 80 events, the wider that survival gap between the two groups could be.
So if we're failing, we'd probably already know because the trial would have wrapped up much faster.
That's the read-through. And this is backed up by the Independent Data Monitoring Committee, the IDMC.
Which is a huge validation point.
It's critical. Back in August, the IDMC gave a positive recommendation to continue the trial without any changes. That's a powerful de-risking event because it means there were no major safety issues and, importantly, no signs of futility.
It was a green light to just keep going.
A full green light.
So the clinical progress is steady, if a bit slow, and the market is just responding with force.
I mean, the technicals here are just impossible to ignore. Breaking above that $5 level for the first time in 3 years, that's a massive multi-year breakout. That old resistance at $4.50 to $5 is now rock-solid support.
It tells you buyers are stepping in on any little dip ahead of the news.
For sure. And we've seen the classic momentum signals. The 50-day moving average just crossed above the 200-day.
The golden cross.
The textbook golden cross configuration. It confirms a really strong uptrend. Investors are positioning themselves.
Okay, so with all that said, let's weigh the risk. Before anyone gets too excited, we have to talk about the primary bear case.
And we have to be very clear about it. The number one risk is binary clinical risk. Full stop.
Yeah.
The entire investment narrative rides on Regal showing a statistically significant survival benefit. If it fails, most of the current equity value, it gets wiped out overnight.
And after this big run-up, some are pointing to the valuation, saying that a 15.6 times price-to-book ratio is rich for a pre-revenue biotech.
And that's a fair point to bring up, but you have to put that PB ratio in context. For a company like this, the book value is mostly just cash. The real value, the IP, the clinical data, the potential for billions in future sales, none of that is on the balance sheet yet.
So that high PB multiple is just the market pricing in the option of a success.
Exactly. It's a symptom of expectation. And speaking of expectation, what about institutional conviction? Are the big players running away?
Or are they leaning in?
They are leaning in heavily. BlackRock, for example, has taken a 5.4% stake.
That's a serious vote of confidence.
And on top of that, an independent director bought over 63,000 shares recently. That kind of insider confidence, especially after a capital raise, suggests they believe in the biology.
So what we have here is a classic asymmetric exposure. On one side, massive downside if Regal fails, but on the other, The signals are pointing toward potential success. You've got institutional backing and a huge potential upside.
Absolutely. A successful outcome justifies a massive re-rating. The company goes from a clinical stage bet to a commercial asset, which immediately puts it on the M&A radar for every major pharma player.
And the SLS 009 platform is waiting in the wings to help mitigate some of that single asset risk.
It creates a valuable dual-platform hematology franchise. It's incredibly attractive.
So if we're looking at the target horizon for you, the investor, how should you be thinking about this?
This is best viewed as a high-conviction, event-driven trade. Your time horizon is defined by the catalyst, so a 3 to 6 month hold right into that Q1 unblinding event.
And if the data's good,
If the data is successful, the thesis completely shifts. It becomes a potential multi-year hold based on commercialization, partnerships, or an outright acquisition.
and here is the final provocative thought we want to leave you with, and it builds on that crucial detail we discussed earlier. The fact that the trial's final trigger, those 80 events, has been delayed because patients are living longer, that raises a really profound question.
Mm-hmm.
If the trial does show superior survival, how quickly will the market fully price in the long-term franchise value of GPS? Will that initial pop after the news capture the full M&A premium, or will it leave a window for more volatility before Big Pharma finally steps in?
It's the ultimate race between the biology and market efficiency.
That's what you need to be thinking about as this all approaches.
Yeah.
That's the lowdown on SELLAS Life Sciences for today. If you haven't already, subscribe so you don't miss our next breakdown. We'll catch you on the next one.